Hey guys, how's it going? Today I'll be talking about common stock, what it is, what it's used for, and I'll show some live examples on balance sheets. So what are common stocks? Common stocks are securities that represent equity ownership in a company. Securities here means piece of paper that proves ownership of stock, bonds, and other investments. Equity means ownership interest in a firm. Security, equity, and common stock are used interchangeably. Pretty much mean the same thing. You'll hear common securities or preferred securities, or instead of common securities, you'll hear equity thrown in it. An example I can think of is if you guys seen the show Shark Tank. Some crazy inventor will come up there and they'll say, I'll offer you 10% equity for $25,000. That 10% equity means 10% of the company, and for the $25,000. That 10%, you could say 10% in common stocks, but it just doesn't sound good, so that's why they say equity. But the equity would be given in common stock. Another way to think about it is common stock. You can think about it as you go to a store, purchase some items, and the clerk hands you a receipt for those items. That receipt proves that you purchased those items. Same with common stock. It proves that you have ownership in a company. If common stocks didn't exist, everybody could just say that they own part of the company. So what are the purposes of common stock? When a company needs capital, that is money, either to expand, keep up with cost, or doesn't want to borrow money, loans, etc., they will issue stock. Expand here could be maybe the company wants to buy new equipment, or they want to build more stores. Keep up could be maybe they had too many employees, electricity's too much, or they just didn't profit enough for the year, and they don't want to borrow money. That means they don't want to go to the bank. They don't want to issue bonds. An example I could show you would be from Burger Queen, made up company that I just made up. Sales, they had sales of 1,000, expenses of 600, and they had a profit of $400. This new grill comes in the market called Burgerinator. Should I call it something else? It's $600, and this new grill makes juicy, delicious burgers in no time. Burger Queen wants to purchase this Grillinator because if they don't, other competitors will, and they'll make juicier, tastier burgers quicker, which will be bad for Burger Queen. They'll lose customers, profit. But seen from Burger Queen's profit, they don't have enough money to purchase the new grill. They're $200 short. Burger Queen could go to the bank and take out a loan. They could issue bonds. Bonds we'll talk about in another video, and or other investment. But instead, they're gonna issue common stock. And a way to issue common stock, first you'd have to determine how much the company is worth. An easy way you could do this, it's way more complicated, but easy example I could show you would be property. Would be $3,000, right? The Burger Queen, the building itself would be $3,000. They could put in the equipment of the property, equipment in the property, 600, and they have 400 in cash, which is the profit that they made. So this equals a net worth of 4,000, and they decide that they're going to issue 4,000 common stock at $1 each, which equals $4,000 in common stock. One at $4,000. The owner of Burger Queen decides that he still wants to be majority owner, so out of those 4,000, he'll keep 2,000 common shares, which is equivalent to 50% ownership. So he's, top dog, top owner. With 2,000 common shares gone to the owner, 2,000 are left. Luckily, the owner has 20 friends that are interested in buying the common shares. Common shares and common stock mean the same thing. Each friend is going to get an equal amount of shares, that is 100 shares, and each friend will own 2.5% ownership, which 2,000 shares at $1 each would equal $2,000 in equity capital. Equity capital here means money used for investment. So now that 2,000 have gone to the owners and 2,000 have gone to the friends, the 4,000 common shares are outstanding. It means they're not in the company anymore, they're out there $2,000 to the owner, $2,000 to friends. So you'll hear that a lot. Outstanding common shares. Why would the friends want to get the common shares? Well, some pros and cons. They will get voting rights, so they decide like if they want to buy the grill, or maybe put up a new burger, delicious burger. That's what voting rights would be. Um, they would also get elections. They would also be able to elect. I'm sorry. They would also be able to elect board of directors, which is, you can think about it as delegates. It's a board that will speak on behalf of the shareholders. What else? Pros are profit. They will get profits via dividends. Well, we'll talk about in another video, or capital appreciation. In the event of liquidation, common stock owners get bottom priority, meaning that they get paid after creditors, bondholders, and preferreds get their cut. Board of directors here means a body elected to govern a corporation on behalf of the shareholders. And capital appreciation means an increase in the market value of the securities. I'll explain that in another video as well. Liquidation here means the conversion of cash. An example is if a company ceases operations, it liquidates its assets to pay off money owed. An example would be if Burger Queen went out of business, it would sell its grill, its property, in order to pay back the shareholders. Shareholders would be, investors as well. But there is a hierarchy. Common stock being the bottom of the priority, preferred stock being would be up on top of common stock, and bonds, and then creditors. I'm gonna show everything here that you don't understand. I will do a video about it. Hopefully it makes more sense. Alright, so let me show you an example. I prepared it here. So I'm looking at Walmart here. You can just go to Google and click Walmart balance sheets. You go down, you go to the common equity, and you go to all of these. I'm gonna teach in no time. You'll be able to read the balance sheet like nothing. But you look at here, you look at common stock, par, carry value. Par carry value means the face value, the initial value, because common stocks are always changing in value. As in, you can see here, it's right now, as of today, it's worth $68.87. At the time they were issued, for who knows how many were issued, it was worth 342 million. So that's what par value, carry value means. It means face value. It means the initial value. Okay, so this is the worth, and as you can see here, this is how many stocks they have outstanding. That means how many investors have it. How many out there in the world. Which is, as of November 28th, they have 3.0 billion outstanding. That's quite a few numbers, and you can see from the charts here, starting from 2011, that it is going down. That means the company Walmart is buying back its stock and retiring them. That's gonna be a different video, but usually when you repurchase a share, it is called a treasury stock, which would appear here. But yeah, like I said, I'll get another video. Hopefully you guys liked the video. I'm gonna write down the next topics in the description and keep making videos. Thank you guys.